Please like, share, and subscribe.
So if we could just start, could you share with us your perspective, your view on the global financial crisis? What caused it? What was the role of the Fed's bailout of the financial institutions? And in your view, what are the lessons that we should have learned, but we did not?
Okay. So yeah, that it was a long time ago, almost 20 years. And can you let me share the screen? I have a very quick PowerPoint that just hits, I think, every question you raised very quickly. And then we can get into the details as much as you want and as much as I can remember.
Sure.
Um, so let's begin. Outline of the causes of the crisis. When the crisis hit, uh, everyone used the term, this is a Minsky moment. And there is some truth in that. But as I will argue in just a second, I think it's better to look at this as sort of the final stage of Minsky's stages of capitalism approach to it. It wasn't just a moment. It was sort of the end of the game of a 50-year transformation of our economy. The main causes were financialization of the economy, layering of debt on debt on debt, and then it began as a liquidity problem, but that liquidity problem uh, was sort of at the top layer, and underlying it was massive insolvency. Um, it resulted in part from shredding of the New Deal reforms that had kept the financial system safe for a generation after World War II. Bubbles and the Goldilocks economy under President Clinton and the movement of the government's budget. I'm not going to say too much about this, but if you want to go into that in more detail, I can do that. And then finally, fraud and the real estate bubble. So, what is the Minsky moment idea? Minsky, beginning in the 60s, started developing this, what's called the financial instability hypothesis. And the argument is that over the course of a cycle, the economy moves from a fairly robust and stable financial system to an increasingly unstable, fragile system. And then that finally results in a financial crisis. Okay. And that was based on his addition to Keynes's general theory. In the general theory, the business cycle is created as a result of investment. Investment is the driver of the business cycle. Okay, so that's the general theory approach. But it didn't really have a theory of how you finance investment. So Minsky always argued what he was doing was adding a financial theory of investment to Keynes's investment theory of the cycle. And so the economy goes through these profiles where a particular profile dominates. In the early post-war period, the profile that dominated was hedge. This is where you can service your debt, you can make the interest payments and pay back part of the principal. And in part because the financial system was so full of very safe government bonds at the end of World War II and hardly any private sector debt, we had hedge finance. The other reason was because everybody remembered the Great Depression, no one's going to take major risks. But over time, he argued, the financial profiles are going to change. We're going to get more speculative positions. Those are positions in which you can make the interest payments, but you can't pay principal. So this must be based on expecting your income to go up so that you can pay back the principal too. And then finally, two Ponzi positions where you can't even make interest payments. You got to borrow more to make interest payments. So your debt is growing and potentially explosive. And as the system gets more fragile, we have a crisis, but the big bank, which is the Fed, and the big government, which is the Treasury, come to the rescue and save the system. But the problem is, every time you're successful as saving the system, the risk will grow. So stability is destabilizing is his most famous saying. Okay, but if we look at our recent, and by recent, I'm talking about beginning in 1980, our recent crises don't fit this at all. We had, and I'm willing to talk about these in more detail if anyone is interested. I studied the thrift crisis in great detail. It's extremely interesting what went on, and it was pretty much replicated in the global financial crisis, but at a scale 100 times bigger than the saving loan crisis. But anyway, it was all about commercial real estate and developing country debt. Okay, so it was not about investment. So it did not fit the financial instability hypothesis. Then we had also in the 80s the LBO, uh, Michael Milken and Jug Bonds, and that led to a crisis in the financial system. In the 80s, in the 90s, we had the new economy and NASDAQ bubbles, what Greenspan called irrational exuberance. That crashed at the end of the 90s into a recession. But we got out of that very quickly because we had three bubbles: residential real estate, commodities markets, and the stock market, which I did not put on here. But three bubbles, biggest bubbles in human history without question. And then those things crashed. But the point is, none of these had anything to do with firms investing and getting into trouble because they borrowed too much to invest. So it does not fit the Minsky moment, which was Paul McCulley's term that I think he came up with for Japan originally, and then he applied it again here, but it really does not fit. All of these follow a pattern, and each crisis is worse than the previous one. So it's better to look at Minsky's later work or at his earliest work before the financial instability hypothesis, where he took a stages approach to the evolution of capitalism. And this was more similar to his own professor Schumpeter's view of capitalism and evolution of the system over time. So we had, back in the 19th century, we had commercial capitalism, and each form of capitalism has a dominant type of financial institution. For commercial capitalism, it's the commercial banks. Then we have the rise of finance capitalism, where the investment projects become too expensive to pay out of retained earnings or family funds. You have to have investment banks. So investment banks are the financial institutions that are important under finance capitalism. This is very similar to Hilferding. That crashed in 1929, and it was replaced with paternalistic capitalism, or Minsky also called it managerial welfare state capitalism. So managerial, where the government works with labor unions and with the biggest corporations to sort of plan the economy, and welfare state because we have put in place a social safety net. But the relative stability of that system, Minsky warned in the 50s, is going to evolve to another kind of capitalism. And he called that money manager capitalism. Now, many other critics of capitalism have come up with a very similar view of what this is all about. Jamie Galbraith called it the predator state. Many people, especially Marxist leaning people, called it financialization of the economy. Even Bush Jr. had a name for it, the ownership society, which put a positive spin on it. Neoliberalism, neoconservatism, or shadow banking, as Paul McCulley called it. So, what is the pattern? The stability breeds instability. You get accumulation of financial assets and liabilities. You have globalization and securitization. Minsky argued you could not have had globalization without securitization. So we had this strange phenomena that the Central Bank of China owned United States home mortgages. That couldn't have happened without securitization. So we spread the vector all over the world because of securitization. The idea was you don't need to know anything about US real estate markets because you can get a diversified portfolio. by buying home mortgage securities. Okay, and then finally, many people say that it was de-supervision and deregulation. No, it was self-supervision. This was actually the policy that was pushed by the Basel agreements. You big, far-flung financial institutions are far too complicated for anybody to regulate. So please supervise yourself. Okay. And so that's what it came down to. All right. And just some evidence of what was going on. This demonstrates Minsky's point. So we have a decline of the importance of commercial banking from about 60% of all financial institution assets to about 20%. Savings and loans is the yellow, and you can see how they virtually disappear because of the thrift crisis. And then finally, managed money is what takes up the slack. So managed money becomes the dominant form. What is managed money? University endowments, pension funds, wealth funds for sovereign wealth funds. So things like that. Managed money under professional money managers, where you have to beat the average. That's the important point. Every money manager has to beat the average or they lose all their clients. And so you've always have to push the envelope to increase your earnings. How can you increase your earnings? Well, you increase leverage ratios. You layer debt on debt. So we have there are different definitions of financialization, different ways of measuring it. Um, a good way to measure it is a rising share of profits and value added that goes to the financial sector. So I'll show that picture. I could present data on the other ones too. Layering debt on debt, positions in assets, financed through short-term borrowing, overnight borrowing in the case of the global financial crisis. What really triggered the crisis was overnight commercial paper, overnight, so that every morning the banks had to refinance their positions in assets. And as soon as there was any scare that maybe the bank was in trouble, they could not refinance their positions. And they're dead. In one morning, they're dead. And then speculation. So here's some data on the financial industry share of corporate profits and of value added. And you can see that both of those increased tremendously. So corporate profits before the global financial crisis, they were getting 40% of all corporate profits. And if you think about how crazy that is, finance is supposed to be an intermediate good. It's not the final good. It's like, the tire on a car. Okay, cars don't really work without tires, but the tire maker should not get 40% of the profits from cars. And that's what the financial sector is doing. And value added also increases. Speculation, here's a measure. Right before the Great Depression, stock market crashed 29. The average holding period of stocks had fallen to 1 year, which tells you that the dominant participants are speculators, because you have a lot of, elderly widows and so on who never sell stocks, right? But we get the average holding period down to 1 year. We did the same thing before the global financial crisis. So it's clearly dominated by speculators. Then we had the support for all of this in the hands of the Fed and also the Treasury. But the stock market, or speculators in the markets, not just the stock market, commodities market too, said, look, we don't need to worry about anything because Uncle Greenspan is there and he's going to bail us out no matter what happens. Bernanke called it the period of the great moderation. You don't need to worry because central bankers are in control and we're not going to let anything bad happen. And as soon as you tell markets that, of course, they're going to go crazy. So they promoted this speculative activity. The reality was, by the way, in March of 2007, or April 2007, we had a conference at the Levy Institute. We had Michigan, who was on the board of governors, and we had two Fed researchers who came to the conference. The two Fed researchers, April 2007, said there are no problems in the residential real estate market. There is no bubble. I gave a presentation, a couple other people from Levy gave presentations. Hold it, we're in the biggest bubble humans have ever seen. Okay. But the Fed was still either completely clueless or just lying, just trying to keep it going. So, anyway, biggest debt, equity, commodity, and real estate bubbles in human history, propped up by the big government and big bank. Securitization, what's that all about? The basic idea is you pool a bunch of debt, mortgages to act as collateral for securities. This was given a big boost by Clinton's budget surpluses, which might sound strange, but the markets did not have enough government debt. And Clinton went on TV and said, we're going to retire all the debt. Okay, we're going to run budget surpluses for 15 years and retire all the debt. And so you can watch him, Google it. You can watch him when he gives this presentation. The whole audience stands up and cheers. Okay, we're going to retire all the government debt for the first time since 1837. The government won't be in debt. Cheering, cheering, cheering. But the financial markets went crazy. Hold it a second. That underlies the whole financial system. What can we find instead? Well, mortgage-backed securities. And in the beginning, of course, what they were securitizing were the mortgages of, nice middle-class white people in neighborhoods with rising prices. The problem was there wasn't nearly enough of the product. And so they kept pushing the envelope to try to increase the quantity. So one way to increase it was to lower the standards for what could be securitized. But the other thing to do was to tranche the mortgage-backed securities and get many more products out of them so that you get riskier tranches for those who want to take risk and get higher return. And then you could start just creating virtual reality securities that are basically bets on which direction the actual securities will go. Okay, so CDOs. So you get all sorts of product that can go into portfolios to replace the government bonds. The underwriting standards deteriorate, and this is on purpose, from low doc to no doc to ninjas, which you actually could go online and find a ninja loan. So some of my students went and they found them. Yep, they advertised them as, and that kind of loan has to be fraudulent. It has to be. The new home finance model was sold on the argument that it's more efficient. It's much, much more efficient if you don't actually have a loan officer. Okay, because that's just a middleman. And what we can do is we can just use credit scores and other methods that don't require actually sitting down. So you can just get your mortgages off the internet. So anyway, what did it actually require? You had to have a loan officer, you had to have a bank teller, you needed a home appraiser, and then you needed a public recorder because all the transactions were recorded and are there in the public record. Okay, then the loans were held to maturity. Okay, that's all it took. The new, more efficient Wall Street model requires a broker, appraiser, lender, servicer, MERS, which I'll get to, securitizer, credit rater, rocket scientists that develop the models to price these things because there really is no financial instrument that is harder to price than a 30-year fixed rate mortgage. Seems counterintuitive, but they're very hard to price because you don't know when the homeowner will refinance. Okay. So then we've got the models, we've got the trustee, because every mortgage-backed security is supposed to have a trustee who keeps those safe. CDOs, squared and cubed, CDSs, credit default swaps, monoline insurers, which is private insurance, investors, traders, accountants, lawyers, lender processing services. And then when everything goes bad, you had to have the robo-signers, the Burger King kids, who would sign documents committing perjury, claiming they had seen the actual documents, okay, which didn't exist. And then document recovery services. The model was originated to distribute, pump and dump, foreclose, and then resell. So it seemed like a good plan. But the problem is every one of those steps requires a fee. And almost all the fees are paid before any homeowner makes a single payment on the loan. Okay. And so that was the problem. It's not more efficient. It's much more expensive to run the system that way. Okay, why the complexity? The model was flawed from the beginning, could not have been profitable. The interest payments could not recover the costs. You needed mortgages at 120% of value to book the fees that have to be paid up front. The complexity, as my colleague Bill Black argued, is essential because accounting fraud is always going to be involved, and you have to make it complex to make it hard to see where the fraud is. So it's on purpose. Everyone was rewarded by throughput. The beauty of a casino is the house always wins. We had $10 trillion worth of homes and tens of trillions of dollars of bets on them. Foreclosure was inevitable. In fact, it was the desired outcome because then you can bet on the failure, get the foreclosure. You need to take the house away from the people, and you need to quickly sell it again in order to hide the fraud. If you've read John Kenneth Galbraith's book, The Great Crash, you know that there's a chapter in the book called Goldman Sachs. And he goes through what Goldman Sachs did in the run up to 1929, and it reads exactly like this. And of course, Goldman Sachs was heavily involved in this one too. And they just repeated everything they had done in the late 20s. Bailout and cover up, no criminal prosecutions of top management. After I wrote those papers, Bill Black and I got in an argument with one of the vice presidents of Bank of America, who because we were saying stuff like this. They're all criminals. They should all be prosecuted. And she was arguing with us on Huffington Post. You can find it. And we were saying it's all criminal behavior. It's all fraud. Anyway, she got prosecuted. She was the only one that I know of. She was jailed. It got overturned, and she walked out free. So anyway, there was one, but she walked out. Anyway, we got the stimulus of 800 billion. Obama said we ran out of money. The Treasury said we can't possibly get any more money than this. Uncle Ben, it's all up to you. We have no more money. And they knew that they needed more. It was very clear that I was with Jamie Galbraith. We were trying to come up with a proposal that he was going to push into the Obama administration. And so we were actually literally sitting in the room trying to come up with a number. He got a phone call. He said, "Oh, they say it's going to be 800 billion." He said, "Why 800?" He said, "Because it's not 1 trillion. There is no way Congress will allow a trillion." So anyway, 800 billion wasn't enough. We found after the release of the data that what the Fed did was spent and lent 29 trillion. So that's what it took to turn things around. Here were the totals. This must be in one of the papers. I don't remember. But you see, it's a mixture of the biggest American banks plus some of the biggest foreign banks. And this is only the banks. So it doesn't include foreign central banks, which was 40% of the 29 trillion. So this is only the amount that went to private banks. Okay, what were they trying to do? Save money, manage capitalism. We we can talk about. Uh, I can't talk in detail about what actually went through Dodd-Frank because I never took it seriously. There was nothing in there that was going to make any major difference. And it's very clear that what happened was we just rebooted the system. There's been no major change. And we are as vulnerable as we were before that crisis.